Reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, sir.
Thank you, Tanvi. Good afternoon, everyone, and thank you for joining us on this call to discuss the financial results of Apollo Hospitals for the third quarter and 9 months of financial year 22, which were announced yesterday. We have with us on the call today the senior management team represented by Mrs. Sunita Reddy, Managing Director, Dr. Hari Prasad, President of the Hospitals Division, Mr. A. Krishnan, Group CFO, Mr. C. Chandrasekhar, CEO of Apollo Health and Lifestyle, Mr. Obul Reddy, CFO of the Pharmacy Division, and Mr. Sanjeev Gupta, CFO of Apollo 24/7. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Please note the disclaimer mentioning these risks and uncertainties on slide 2 of the investor presentation shared with all of you earlier. Documents relating to our financial performance have been circulated earlier, and these have also been posted on our corporate website. I would now like to turn the call over to Mrs. Sunita Reddy for her opening remarks. Thank you, and over to you, ma'am.
Good afternoon, everyone, and thank you for taking time to join us on a Saturday afternoon. I trust that you've all received the earnings document that we shared yesterday. The third quarter of FY22 witnessed a very strong revival of non-COVID business, with volumes reaching pre-COVID levels despite holiday season seasonality and without significant contribution from international patients. Our efforts on garnering local market share continued, and we saw a healthy uptick in local patients. We saw payer mix shifts on 2 counts. First, our deep engagement efforts with self-pay and insurance segments, as well as a general increase in patients who opt for quality healthcare providers like us, helped the cash and insurance segments grow by approximately 10% on volumes and over 25% in revenues compared to pre-COVID quarters. Secondly, we rationalized our lower-paying patients across the network, leading to an improvement in ARPOB. Our rupees 46,062 in Q3 FY22 versus 36,868 in Q3 FY20. ARPOB improved on the back of focus on high-end centers of excellence and evolving case mix. We believe that this is a result of our conscious investment and prioritization that is sustainable in the long term and is founded on our specialities that will continue to drive our business going forward. New hospitals continue to ramp up, and we have seen a good traction in volumes, revenues, case mix, and ARPOB in these hospitals. Volumes grew by 17% over Q3 FY20. Revenues grew by 46%. Inpatient revenues witnessed a 30% revenue growth versus Q3 22, where in Q3 22 versus Q3 20. This included a growth of 31% in cardiac, 44% in onco, 21% in neurosciences, 31% in orthopedic, 27% in gastro. At the same time, we continue to keep a small number of beds allocated for COVID patients with a strong iron curtain between COVID and non-COVID patients in place. However, the percentage of COVID patients treated was much lower than Q2. The COVID-occupied beds in Q3 was only at 203 beds versus 348 beds in Q2-22. Overall, inpatient volume grew 28% over Q3 FY21 and 2% over Q3 FY20. Vaccination volumes continue, but at a much lower scale than Q3. We inoculated 5.7 lakh people, including AHLL. Q3 included vaccination revenue of 50 crores as compared to 246 crores in the previous quarter of FY22. Against this backdrop, let me walk you through the financials for the quarter. On a year-on-year basis, standalone healthcare services revenue grew by 24%. Combined pharmacy revenues year-to-date grew 20%, while quarter 3 revenues grew over 15% year-on-year as compared to a muted previous quarter. Both our new hospitals as well as mature hospitals recorded a revenue growth of 23% on a year-on-year basis. Margins in the mature hospitals are the strong 26.5%, and I am happy to state that our margins in new hospitals continue to witness improvement, moving to 19.5% for the quarter, registering a 367 basis points improvement on a year-on-year basis. The pharmacy business overall is demonstrating good momentum despite the uncertainty of demand and stocking and uneven quarterly patterns that we have had to deal with since the first wave of COVID. Our current focus is on accelerating the overall pharmacy revenues through a combination of both offline and online channels. Standalone post India's 116 EBITDA was at 424 crores, registering a year-on-year growth of 32%. Healthcare services EBITDA was at 383 crores, a year-on-year growth of 55%. Pharmacy distribution EBITDA stood at 96 crores with an EBITDA margin of 7.4%. Apollo 24/7 costs were at 55 crores. The pharmacy division also accounted for its annual salary increments from October 2021 onwards and awarded a one-time incentive payout to staff of 10 crores, which is reflected in the financials. Standalone PAT was at 175 crores compared to 106 crores in Q3 FY21. Net debt as of 31st December 2021 was at 1,030 crores with a debt equity ratio of 0.04. Our consolidated revenues were at 3,639 crore against 2,760 crore in Q3 FY21. On a year-on-year basis, healthcare services revenue grew 41% to 2,018 crores. Mature healthcare grew by 40% to 1,412 crores, while new hospitals grew by 40% to 559 crores. Group occupancy was at 65%. The consolidated post India's 116 for Q3 FY22 was at rupees 587 crores compared to 390 crores in Q3 FY21, a growth of 50%. Within this, healthcare services EBITDA was at rupees 496 crores compared to 288 crores in Q3 FY21, a growth of 72%. Our retail business, Apollo Health and Lifestyle, has recorded an impressive revenue growth of 59% compared to Q3 FY21. AHLL's EBITDA post India stood at rupees 50 crores as compared to 28 crores in FY21. The diagnostic business continued to grow at a pace of 55% over Q3 FY21. Our network and phlebotomy expansion plans continue. The consolidated PAT is at 228 crores. Over the calendar year 2021, we have strengthened our businesses across all aspects, ranging from infrastructure, medical teams, protocols, processes, and of course, the transformation of our healthcare delivery model. About 2 weeks ago, we shared an update regarding our plans to list our pharmacy products on the Amazon platform in India. This, we believe, will accelerate the momentum that we are witnessing in pharmacies and Apollo 24/7, which has scaled rapidly and has emerged as a distinct offering, enable us to elevate the consumer experience for the Apollo consumer. While our transition into Q4 has been characterized by the emergence of the third wave of COVID, We are confident that the fundamentals of our business continue to remain strong, and we have developed the flexibility to adapt to COVID needs very quickly and have institutionalized our focus on areas that will deliver long-term sustainable value. On that note, I would like to hand it over to the moderator, and then I have Dr. Hari Prasad from the Hospitals Division, our CFO Krishnan, Obul Reddy from the Pharmacies Division, Chandra from AHLL, and Sanjeev from 24/7 to take all your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prakash from Axis Capital. Please go ahead.
Hi, thanks for the opportunity. First question is on the, while we've seen good improvement in hospital business margins, wanted to understand the pharmacy margins are tad lower versus last quarter. Is there a particular reason? Is the private level sales gone down, or what has led to some EBITDA margin decline in the pharmacy piece?
The private label sales remain at about 11.8% in Q3 current year against last year 9.8%. We are growing on that front. There is no issue on that. But as explained in the in the preamble, there is one-time cost because our increments on the employee cost falls in Q3, and we have considered a one-time incentive to employees because of the challenging hard work they have done in the challenging COVID time. So if you look at it, the 10 crores cost, then the EBITDA difference between the two quarters is about 7 crores. To adjust that, and then we are in line with other quarters on the EBITDA numbers, and we are confident we will continue that in the coming quarters. And there is no margin erosion at all at gross profit level because of the private label growth.
Okay. And this is, you are saying one time, or this is an annual event?
This is one time, and the incentive, one-time incentive is one time. Our annual increments get absorbed in the normal system. The one-time effect is about 10 crores.
Okay, understood. And just for understanding, this 24/7, you still not given the numbers, but where is the service fee and the related cost sitting currently?
We have disclosed that, as a part of the back end in the last 3 quarters, the expenses relating to the product development. Last quarter it was about 48 crores. This year is about 55 crores. This is a separate line in the presentation. And the revenue is at the entire health, digital health platform, which separately Mr. Sanjeev will explain when the numbers required.
Where is it captured? Is it in a hospital line? Is it in pharmacy line, or is it like distributed over?
It is the health. It is in the hospital line partly, but it is not in AHCL. It is in the ACL on the pharmacy side. So that will get segregated and get reported from this quarter, as we are expecting soon to effect to the back end slum sale, and then have separate numbers disclosed from next quarter.
From Q4?
From Q1.
Okay. And cost-wise, you said there is a separate cost item you are giving. In the overall P&L, it is sitting where? In other expenses?
It is in the back end, other expenses, yes. And we made a disclosure of what that amount is quarter on quarter for the last 3 quarters.
So 55 crores is for the third quarter?
Entire platform.
Yeah, it is for the third quarter.
Yes, third quarter.
Okay, and just last one, the outpatient number seems to have come down dramatically. Is it due to lower vaccination run rate, or we have seen, what is the other reason?
Vaccination.
Okay, so this is the normal run rate that we will see going forward if there is no major COVID outbreak.
There is still vaccines in this quarter as well. So, there is, as I see, so there is still 70,000 to 80,000 numbers of vaccine in this quarter as well.
Okay. Understood. Fair enough. Okay, I have no question. I'll join back. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Sales. Please go ahead.
Yeah, hi. Good afternoon, everyone. First, just taking from Prakash's question further, if the bulk of 24/7 revenues is coming from the medicines, and if you adjust that from the pharmacy segment, would you say that against the 16% growth which is reported, adjusted growth will be less than 10%?
No. It's about 13-14%.
Why would that be? Because I'm assuming that you will be doing at least 60-70 crore or thereabout in 24/7 at least, right, revenues, and bulk of that coming from pharmacy.
The 60 crore translates to 3% on 1600, 4% on 600 crores. So if you adjust, it is about 12 to 13%. Exactly, it is not 16, slightly a different number.
Sure.
But if you adjust that, yeah.
And do you want to talk about what ma'am talked about initially? What is the problem which is happening in the pharmacy segment? Because you have added about 10% additional stores. So the same store sales growth is turning out to be much lower. So after the first wave, why are, let's say, your retail partners not, let's say, what's the exact issue that why pharmacy segment is not going well?
What we are seeing last quarter is uneven quarterly growth. If you look 9 months YTD, we have last 9 months about 21%, and this 9 months it is about same 20% growth. So at an overall level, growth is maintained. Now you have a Q1 where a quarter-on-quarter growth of 30% over last quarter, and then followed by a 16% degrowth in Q2 over Q1. So there is some hold purchases, there is some hard rush of the COVID items, then followed by we have to adjust to the normal items. These are all happening. Even if you see last year, you have a quarter where quarter-on-quarter growth of 16% versus 3% in Q3. So COVID, followed by the COVID, there is 1 or 2 quarters this adjustment is happening. If you see Q1, we have degrown 16%, and again come back strongly quarter-on-quarter growth of about 8.5%.
Q2 you degrown.
Yeah.
Okay.
So hopefully this is happening in the system across.
Okay, sure. Just second set of question was on the Amazon deal. Just a clarity. When you referred of a $1 billion revenue number in year 3, was this a cumulative number that you plan to do over year 1, 2, and 3, or were you referring to this number as a year 3 potential revenue from year 3 onwards as annual revenue?
Sanjeev?
Yeah, so hi Sanjeev this side. So I think this is a little futuristic and forward-looking statement, but for sure what we are looking at is that third to fourth year, we should have a total cumulative, 1 billion. And so I think the guidance should be that cumulative 3 to 4 years should be 1 billion.
Cumulative, okay. And the
$1 billion was the overall target that we have given. Yeah, and that's the cumulative, as we said.
Sure. That is clear. And the second question is on the Amazon deal is there any minimum commitment from Amazon in terms of promotion spend, etc.? Or can you talk about a little bit of the length of the contract with them, etc.? I appreciate last time you mentioned this is not exclusive.
So I think at this point of time, what we can say is that it's a 10-year contract, and specific questions that you asked. So I think that at this point, we would like to defer it for a subsequent period.
No, Sanjeev, I'm not asking for that amount, but I'm just trying to say when you have a 10-year contract, what is so that both the parties benefit? Is there a minimum commitment? Because the commitment may not be on the business front, that whether you reach $1 billion cumulative or not, but is there minimum commitment on what each party needs to do?
So there are arrangements. Yeah. Sanjeev, I'm not sure whether you can give this commercial arrangements here, right?
No, I think there are roles and responsibilities, which, both the parties have it. And depending upon the rules and responsibilities, I think those are the committed to do items or activities performed by each one of us, so which is Apollo and Amazon. And yes, there is a commercial arrangement. At this stage, I think this is all what we can share.
Sure, I appreciate that. If I can ask one just clarity on the hospital business. This quarter, Tamil Nadu segment had a very strong utilization of 66%, maybe one of the highest you guys have ever done, whereas Karnataka was really low. So can you just talk about what happened in the two geographies, where ARPOBs are pretty decent in both the geographies, but utilizations were very, very sharp. One was Tamil Nadu was a very sharp increase and Karnataka was a very sharp decline.
So in Karnataka and AP Telangana, there was more vaccine revenues in Q2 than any of the other regions. So the highest, incidentally, the highest vaccine usage was in Bombay, followed by Karnataka and then AP Telangana. So which is the reason that the lumpiness was there in the overall revenues. But the Karnataka numbers from an overall revenue and EBITDA perspective remains intact. They've done well, and the insurance benefit that we spoke of when we said that versus last year, pre-COVID levels, we are seeing 25% growth in insurance, which Bangalore has also got the benefit of that. So the numbers that you're seeing for Q3 are because of the lumpiness in volumes because of vaccine.
And Tamil Nadu?
Tamil Nadu, we didn't have so much of vaccine revenue in Q2. Q3 has been good because we saw some of the patients coming from out of station, etc., coming back slowly. Tamil Nadu, as you know, has the highest dependency on out of station patients because of the fact that it is one of the best hospitals in our system, and people from east and northeast, etc., have started coming back. Medical value tourism has not yet seen any uplift in this quarter versus last quarter. Hopefully, going forward, we will get that benefit as well.
Thank you very much. I asked too many questions, but the clarity on this Karnataka one, vaccine revenue should not lead to in Q2 a high utilization, right? The utilization has dropped for us. So that was the question.
I'm just saying, first I'm saying of the revenues. Okay, you're saying the utilization bed occupancy rate is what you're saying,
yes.
Is it?
Significantly declined in Karnataka. So for example, your data shows that it was 70% plus utilization in second quarter. Now it's about 55% utilization.
No, it is 60.
It is actually occupancy.
It is 64% for this quarter. I don't know the data, how you arrived at the data. You can take it offline with Krishna Kumar. That 70 that you are seeing is 64% for the quarter, as we have the numbers with us.
Sure, I'll check that. Sure, thanks.
Yeah,
thanks.
Thank you. The next question is from the line of Shalin Kumar from UBS. Please go ahead.
Yeah, hi. Thanks for the opportunity, and congrats to the management on a good set of numbers. So, if management can provide a timeline for the fundraise, because that could be a key trigger to accelerate our 24/7 growth. So, any timeline possible to share that when we are expecting it to close?
I'll take this, Sanjeev. So I think the important thing to remember is that for 24/7 that we had 3 phases that we envisaged. The first was doing this construct with Amazon so that the volumes on the digital grow. The second part of it is the slump sale of Apollo Healthco, which we hope to complete by March. And when that happens, I think the investment will fall in place, so we'll be able to announce the investor. So we're close to completing second phase, and soon after that, we will quickly come to you with the names of the investors.
So, ma'am, right to assume maybe in next 2 to 3 months, we should be all the 3 phases should be done.
Yes, you're right. Yes.
Okay. Thank you. I have another question on AHLL. So, very impressive growth happening over here on the top line basis, and obviously the margin also improved. So, just want to understand what exactly is happening. Is it the pricing are going up, or the driven by footfall? Because I believe vaccination revenue would be lower. So, what exactly is happening here? If management can provide a picture over here.
Ma'am, I'll take that. Yes. I think it is a concerted effort. There are two things that have changed from quarter 2 to quarter 3. We continue to grow our stated strategy on diagnostics. We have added many more collection centers which are starting to contribute. We also have deepened our home collection capabilities, and they are contributing significantly more than in the past. Similarly, primary care and secondary care both saw the revival and bounce back of elective and footfall, and significant among them. You are right. Actually, this is net of actually a lower vaccine number in Q3, far lower than Q2. However, shows impressive growth because of systemic improvements in diagnostics and elective as well as primary care footfall.
Right. And then, just one question on the hospital segment. Again, there is a remarkable improvement in margin, both in mature and new hospitals. Now, obviously, there is a pent-up demand, and there's a change in payer mix. So it's difficult for us to, or for me at least, to ascertain that how much of it is sustainable in terms of margin. If let's say there's a lot of pent-up demand of critical high-end surgery, which may moderate, and then margins can come down. So what kind of margin should we assume? Once this pent-up demand comes down a bit. In both the sectors.
I think that this is a sustainable margin trajectory. We've showed that even quarter on quarter we've improved our margins in mature hospitals by 1.3%. So I think this is a sustainable trajectory. We are looking at 25% and on a blended basis over a period of time to bring it to that level. And this is done because of case mix, payer mix, and focus on, I think we're all, and the focus on cutting costs.
Okay. So a part of this margin improvement is led by cost cutting, and that's, you think, is sustainable. So we can say.
Yes, showing through this quarter also. We started last year. So.
Yes. Yeah. All right. I thank you. That's it from my side, and I'll join back the queue. Thank you so much.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, good afternoon, everyone, and thanks for this. Just for your core, hospital business, from 64-65% occupancy, I mean, how much room do you think you have to grow this? And second, also on ARPOB, where we are 47,000 rupees, do you think you can grow this by whatever 8-10% per annum for next 2-3 years?
So, Sameer, with regard to occupancy, we have mature hospitals trending at about 68%, 67 to 68% occupancy. New hospitals at 61% occupancy. If you look at both, there's a headroom of at least 15%, which will be our focus for the next 24 months to improve occupancy, moving to 75% occupancy blended. That is one part of it. The second part of it is that as we reduce our loss, like for example, our occupancy was very high during COVID because the loss was 5. Now we've come back to less than 4 at about 3.9. So again, there's headroom to grow. So while we are focusing on asset utilization, I think you can see that without investing too much, we can really grow 15% in terms of occupancy. Your second question on ARPOB being at 48,000, I think this is a really good ARPOB because what we've done is, we've rationalized some of the schemes. But it's something that, in Tier 1, we're in excess of we're close to 60,000 rupees. But if you take the fact that, we have to blend it with Tier 2, where we cannot expect to reach anything more than 40,000, I think that around 50,000 is a good ARPOB. And we will continue to focus on the quality of revenue. Let me just add that this is without international patients. So hopeful that when the international patients open up next year, we could see some improvement in our ARPOB.
Yeah, that's great. Sunita, I'm just trying to understand whether the whole hospital network has sort of, reached some sort of upper threshold, and so the growth can be challenging, overall growth, all these points put together, do you think you can grow at, early teens, mid-teens per annum for next couple of years for the hospital business?
Of course, I think, built in the system, we can operationalize another 500 beds. The fact is that, we're at the asset utilization of 65% where beds are concerned. So just looking at that, yes, and beyond that, we are focusing on the surgical work, which actually improves our ARPOB. And, apart from medical discharges, which we saw in the first quarter and whole of last year, I think this improvement in surgical is really going to lead to superior ARPOBs.
Yeah, thanks for this, Sunita. The second question I have is with regard to balance sheet. I think it's a great job done on, cutting down leverage. After the slump sale proceeds, my guess is you'll be net cash company or net debt zero company, after 1,200 crore comes in. Plus you'll be generating a good, 1,200 crores of free cash flow, or if not more. So how do you see this deployment of capital over next 2-3 years?
Absolutely right.
Yeah. Yes, please go ahead.
You're absolutely right. So the way that we see deployment of this is that we're expanding our presence in Bangalore, where we're coming up with a new facility. In terms of brownfield, we are adding because we have the land, we're adding around 400-500 beds in the next 2 years, plus a greenfield of 300 beds. So that is capital deployment for Karnataka itself will be about 600-700 crores. We believe that region has high potential. The second area is that we're looking at, we will very quickly close out Bombay, where we have we're working with a trust, and we hope to put up 400 beds in should I say the center of Bombay. It's about 15 in Baikula. So that we should close out at a cost of 600 crores plus 2%, we're going to pay 2% revenue share. And that will happen within, the facility will come up within the next 3 years. The third area that we're looking at very closely is the northern area, where we're looking at Gurgaon. There's a potential for a brownfield in Gurgaon. We're looking at North Delhi, where we are looking at both land and a brownfield, and we're looking at Noida. So once we consolidate our presence in these markets, and if you look at Delhi and Bombay, they're like 50,000 crore markets, and still a shortage of beds. 5,000 beds short in Delhi, and about 15,000 bed shortage in Bombay, and Bangalore continue to grow. I think these are the 3 markets where we want to consolidate our presence, and by doing so, I think by improving market share, we're quite sure we'll attract the best clinical talent and also move to better ARPOBs.
Yeah, thanks. And just to conclude on this point, so in 3 years' time, in these 3 markets, you think you can add 2,000 beds here?
Yes.
Okay. That's excellent. Thank you so much.
Thank you.
Thank you. The next question is from the line of Lavanya Totala from UBS. Please go ahead.
Hi. Good morning, everyone. Thanks for the opportunity. So I just want to understand if there is any disruption in non-COVID business in the current quarter, as in the Q4, because of third wave.
In Q4, is that for Q4?
Yes.
Yeah, Q4.
I think there is a slight, because January was, I think the peak of the Omicron wave. Things are looking better now.
Okay. Okay, got it. And in hospital business, so in Q3, is it fair to assume the whole domestic medical tourism, everything is normal, everything is back except the international patients?
Yeah, I think that, the medical value travel has not happened, and that was 10% of our business. So clearly, quarter 3 is reflecting a strong India growth story.
Okay, got it. And in the okay, and in Apollo Diagnostics, so more or less in Q3 everything is from the non-COVID business, and we can expect it to grow from here, right? So there is no COVID business in Q3.
Q3 very low COVID business. Majority of the business in Q3 is non-COVID, and yes, we expect to grow on the current base of non-COVID.
Okay, so how? I mean, any broad estimate like mid-teens that we expect to grow, and mostly largely through organic, inorganic opportunities that we are looking in this space.
We focused on organic with market saturation, efficiency and productivity increase, home collection by a larger ability to expand our phlebo network besides the collection network, and saturating existing markets in south and east where we are strong. But also we also want to look at an overall mix of getting into some new markets. Inorganic is opportunistic, and it is something that we are mindful about the price we pay for inorganic as well. But we are watching it closely, and at the right time such opportunities we will grab opportunistically. We would like to target upward of 50% growth on the diagnostics business on a non-COVID, and a mix which could keep altering based on the revival of COVID or any future waves. But definitely overall 50% plus target growth.
Got it. Thank you. That's it from my side.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Thanks for the opportunity. Just on quarter-on-quarter basis, for the new hospitals, the revenues are down while the occupancy is more or less intact, which does imply that ARPOB has fallen at least to 40,000 if my calculation is right. Can you explain this?
No, so again, it was the vaccine revenues. As I said, when we said Bangalore, the highest revenues on Bangalore came from Jayanagar, Malleshwaram, etc. in the new hospitals. And again, Indore there was vaccination. There was vaccination of New Bombay. Navi Mumbai was the highest vaccination, as I said, across the company. So it is all due to significant vaccine revenues. Almost 50-60 crores of higher revenues which were actually coming from the new hospitals itself.
So this 40,000 is what the base ARPOB to consider going forward, at least in the new hospitals.
Yes, this current quarter, yes, 40,000. Yes, that's correct.
Also, if you could just help me with the patient mix, as in the percentage contribution from the different class of patients for the quarter or for the 9 months, whichever is convenient.
So I think we can take that offline. Broadly, we have self-pay and insurance itself is over 75% of our overall revenues between self-pay and insurance.
Okay.
And just focus.
Sure. And just lastly, while just taking as a trajectory from Q3 to Q4, given that Jan had relatively less of if you could just throw some light on how the occupancy was in January and accordingly how the hospital business would be. While February onwards things are getting a bit normalized, but particularly Jan would have impacted our hospital business.
I think it's just closing the COVID. I think some of this will be forward-looking. We didn't want to give that now, and I guess Jan was a bit low, but we are seeing the bounce back again in Feb. So let's see it.
All right. Thanks a lot.
Thank you. The next question is from the line of Prakash from Axis Capital. Please go ahead.
My questions have been answered. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Sales. Please go ahead.
Yeah, hi. Thanks. So a couple of questions. One is, right now, as you mentioned in the last call, on the 24/7, on the customer acquisition cost, you guys are spending roughly about 150 rupees. Post the capital raise, where do you think this number can be? And I'm just trying to understand this because I see some of your peers are spending north of 600, 700 rupees customer acquisition cost. So do you think you will gradually reach there, or 150 is a very low number? For you, it will be 300, 500? Some idea can you talk about?
Sanjeev?
Yeah. So I think it is a mix of many things, that you need to think about, because, we've got a couple of strengths, within the Apollo ecosystem. One is that we've got the Apollo brand, which is a 40-year-old brand, trusted, and that is one pull. And the second pull is that we also have, organic growth coming into the platform, and the acquisition is at no cost. Third, we've got relationships with some of the big corporates for their employees and for their customers. All these three buckets actually give you the customers at almost nil cost. And as far as the other areas are concerned, which are paid marketing areas to get the customers, obviously their cost is little on the higher side. We strongly believe that we are looking for chronic customers, and those are the customers which give you a good LTV. And I think at this stage, 150 rupees. I think for the next 6 months to 9 months, it should be in the range of 150 to 200. It shouldn't go beyond that. Maybe after 2 quarters or 3 quarters, we'll be in a better position to talk about maybe after 2 years, 3 years, where would that direction be.
So, Sanjeev, the idea of the question was that today you guys, let's say for example, in terms of print ads or on the TV ads, etc., I am not sure whether you guys are very aggressive today, but post the fundraise, let's say once the money comes in, what will change in terms of promotion to the, let's say, I'm just looking at a flavor in the sense, would the discounts go more aggressive, or would the marketing and the promotion efforts, let's say the advertisement portion goes up dramatic? What changes in the system so that you can significantly reach closer to your target of 100 million users, which you have over till next 3-4 years?
Yeah, so I think directionally what we're looking at it is post infusion of capital. I think there would be a bit of more marketing, advertisement, and those activities to acquire customers. So I think that is something which is given. We'll do it. And obviously, there will be some inorganic stuff also happening into the system. So I think yes, but as far as the discount side is concerned, I think a couple of calls, this has been answered that we are not in the race of, giving high discounts. And at the end of the day, what we've understood is that users are expecting a continuum of care. What they expect is that a quality, a trusted brand, and wherein, the entire offerings of a omni-channel could be given to them. So there are a set of users, there are a set of patients who are looking for that side of a offering versus, just a discount play. But obviously, we are not going to be a discount play. We will not play that game for sure.
So I think just to add to Sanjeev's remarks, the important thing to realize, and I think that everyone who spoke to us about Apollo going online is really that we need to build momentum. So Amazon is part of our play to build that momentum, and we're quite confident it will happen. Meanwhile, we're strengthened by an omni-channel presence, which is the stores that we've opened, and we've added 200 stores this quarter. So we continue to play in that space with a very, very strong pharmacy presence, added to which we have, the teleconsults, we have the diagnostics, and very soon we're adding the condition management.
So my one question over there, and to both of you, that when Sanjeev talked about some inorganic acquisition, so are you talking about this on the capability side, adding to the 24/7, or are you talking more on the logistics side of fulfilling services there? And what capability, if the answer is on the capability side?
I think it is too early to talk about this. Give us some time. Once we have earmarked, those set of companies, then probably we'll talk about this. Little too early in the game to talk about them.
Sure. Thanks, Sanjeev.
To add to Sanjeev, I think, when we talked about 24/7, we said that it will add a whole suite of services. This was not just a transactional business for pharmacy online. And as part of that, we will be looking at adding additional services through inorganic growth.
Okay, sure. And just a clarity from the presentation. So there was two different numbers, so I got confused. So when you mentioned about online consultations in the quarter, so the slide 7 mentions that on the 24/7 platform there were more than 1 lakh consultations in the quarter. The slide 22, where we talk about all the metrics of Apollo 24/7, that mentions that the cumulative number changed by 3.5 lakhs in this quarter. So, which is the correct number? On the 24/7 platform, how many consults you had in this quarter?
Yeah, so we had about 100,000, consultations during the quarter. So that's the right number. And then it's 40,000 to be precise. Yeah.
So roughly we are doing about 1,000 to 1,200 consultations a day right now.
Yeah, but the way to look at this is that, the Omni side of it. One is that the way we look at it is that, customer has got the convenience to do, take any offering, either to the platform or through platform, can get the offline also. So I think this is the way we look at it. So if you look at it pure 24/7 app related consultations, you would come to that number. And then if you look at the customers of 24/7 might as well would have gone to the offline and then got the consultations done. So that is another angle that we always look at it. So we look at it from the Omni point of view. Just a clarification there.
So those two numbers we should read like this: 1 lakh consultations happen only on 24/7 platform. That's 3.5 lakh number that you have. Those 2.5 lakhs were basically customers went to the app but took offline appointment in the hospital.
So 3.5 would be the cumulative since its inception.
Okay, I'll take that number. Actually, the cumulative is 11 lakhs, what you mentioned in the presentation, but I'll take it offline. Sure. Thank you very much.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. You talked about your plans for North and West India for the hospital business, for Bombay and Delhi to be precise. Now in Bombay, barring putting up this new hospital in Northern Bombay, is there any other plan to beef up our presence? Barring a new Navi Mumbai hospital in this location?
Yes, Sunita told you about South Bombay. So what we are focusing on is, I don't think we've still announced it because, we're still working on getting it closed. And, the Baikula facility is something that we had earlier, as you know, with the Masina Trust. And we are quite hopeful now that in the next 6 months, we should be able to conclude this deal and take it forward.
So, and I think, added to that is the fact that Apollo Health and Diagnostics, we will continue to look at growing daycare centers, clinics, diagnostic centers, and as well as working centers in Bombay.
Okay. Now, is it fair to say that, so you talk about next 2-3 year plan, but even when you take a slightly long-term view, given the fact that Mumbai and Delhi are probably the most premium markets from a portfolio perspective in the country, there is going to be a lot more focus on these two markets from an investment perspective on the hospital side as we go along?
Yes, a lot more focus on these two markets. And through both AHLL, a combination of both the hospital division, AHLL, as well as 24/7
Okay. And secondly, on the AHL business, the diagnostics piece currently at about 20% EBITDA margins, and you talk about a 50% growth, organic growth in this business. So, I mean, till how long? So two things. One is, A, where do we see peak profitability for this business? And two, given there has been a very sharp increase in competitive pressures in this business with lot many new players entering, does that in any way change our own outlook on how we're looking at the business from a profitability and growth perspective on a 3-year period?
Chandra?
Yes, ma'am. I'll answer that. So I think we have still a lot of headroom in terms of the fact that we have relatively no more newer entrant into the market. This opportunity comes on the back of the fact that we have an extremely strong brand salience in many markets and most of, if not all of India. And our market saturation journey is something that we have begun robustly, and this will continue. Opportunity is not just from competing with organized, but actually the shift of customer preference from unorganized to organized is auguring well for the entire bucket of organized itself. So that shift is going to happen more rapidly. I think COVID is a clear pointer as to where people are preferring that shift more so than in the past. So we believe that a combination of our own market saturation and the shift of unorganized to organized, this is one bucket. The second area in our own journey and why we believe our growth rates can be faster, margins are an outcome of the fact that we are also not in full steady state. We will continue to grow, which will there will be new shops, there will be new capex, new investment, new markets. So there will be, what you're seeing is a cumulative. So we would continue to add some bit of losses in the early stages of expansion of our network. The journey on moving from higher component on B2C, deeper component on higher end super specialized and semi-specialized testing is another headroom that we are hoping and we are concentrating on, not just hoping, but we are dedicated to increasing our capabilities there. And that is going to only help us improve our ticket size, our overall network, and our gross margin and profitability.
So, what is the share of B2C versus B2B in the diagnostic business today?
So, at this point of time, we are nearly equal. Actually slightly higher, 55% of B2C.
And where do you see these numbers trending in 3 years?
Sorry?
Where do you see these numbers, the B2C number ending up in 3 years?
So we are growing both B2C and B2B, as you know. So I think from an industry average and amongst the top players, the numbers are more like 60-40. And I do not see us to be very different. 60 on B2C.
Chandra, when you're saying B2B, you mean franchise, is it?
Sorry, B2B, when I mean to say is third-party labs.
Yeah, so it's not any bulky hospital revenue.
For offices. Sorry?
Yeah, so it's not bulky hospital revenues is what we are. I would like to say 10 little.
Yes, third-party labs are in third-party hospitals.
Smaller ones.
Yeah, smaller ones in our case, yes.
Okay. And so just fair to say, given the growth that you you highlighted, so we can probably look like 1,000 crore revenue for this business with 20% plus EBITDA margin in 3 years. That's a fair number to go with.
So we are approaching this with the same intent, but as we have consistently committed to rapidly grow our diagnostics. I am inclined to mention that we have had conversations in the past calls on when are we going to do the 300, when are we going to do the 500. I think 500 looks more easily possible and definitely within our reach in the coming year itself, and we'll definitely breach that. And we want to maintain that CAGR of growth consistently for the 3 years, and that should evolve to a number which should be directionally what you're suggesting.
Thanks. And like second squeeze the last one on the HL business. So there is a new platform that you introduced around the nephrology, the dialysis business, and the IVF. What is the thought process behind these businesses, and what kind of opportunities do you see in these spaces?
So dialysis, barring one organized player who again has a very early start, a pure play dialysis player. I think the rest of the next round of players are not as systematic as what we approached. I believe that nephro and chronic kidney disease market is something that is definitely going to continuously grow, and our abilities to offer the standalone, and also the second focus is on shop within hospitals, and that's something which we are focused on as a major area. The third element of growth is on the fact that National Health Mission has pledged a significant support to state governments for PPPs that they are wanting to do in dialysis. We are cognizant of the fact that PPP will be a area of outlook for us, but then we are wanting us to at least be a 60% private third-party shop hospital. That's the area of growth. In terms of our growth, we are hoping to add significant volumes in FY23, and we have shops lined up for starting activity. We are going to add beds and sessions there. Dialysis market we are bullish about, and hence that's endeavor, and there is clear space from the fact that the leader to the next rung is a wide gap, and we want to creep up and bridge the gap onto the leader in the pure play dialysis play. On IVF, we are again looking at two things that are happening. One is a very clear indicator of the fact that IVF as a play is going to be far more regulated than ever before, with the introduction of the ARP and the surrogacy bill. Very clearly, the requirements on infra, quality, as well as the fact that we will have a national agency which is going to monitor outcomes and quality indicators, and it will become mandatory for players to participate. Players to participate in the repository. The fertility play is going to become extremely good and tailwinds for organized players like us. So we are focused on growing that network.
These two segments, by what, given the size of the HLL business today, by when do you...
Sorry, there's a lot of echo. I am unable to hear the question clearly.
I think someone else's phone is on.
Hello? Can I go now? Please repeat it. Yeah, so in all these two pieces, given the size of where HLL piece today is, diagnostics are not going very rapidly. Already you've got Spectra and all which are reasonable size. By when these two businesses on their own independent rights starts to become meaningful businesses? Is it a 3-year journey? Is it a 5-year journey for you?
Yeah, I think it's a 3-5-year journey, and both these have the potential to become meaningful businesses within our portfolio. As you're aware, the intent of HLL is to serve customers closer to communities and also provide them a continuum of care to the large format AHCL hospitals. And that is a remarkably different value offering that we will give. While we play similar to individual players within each of the sub-formats within HLL, we also are cognizant of the fact that we are best placed to offer the continuum of care. So hence IVF, for example, leads up to the cradles and the large hospitals for deliveries. And this is a journey that I think we can uniquely offer. And this is something that hence we are focused on. Similar on dialysis, the onward journey of a CKD play into nephro and transplant play is something which is very close to us. So these are likely to become meaningful, but yes, it does take time because these have been more recent entries for us.
This is all very interesting. The chief possibilities. Best of luck, and thank you.
Yeah.
Thank you. The next question is from the line of Shyam Hassan from Goldman Sachs. Please go ahead.
Good afternoon. Thank you for taking my question. I apologize for the background noise. I'm outside. But first question is on the key metrics for Apollo 24/7. I see the presentation slide, but you also share stuff like online deliveries per day, total omni-channel deliveries per day. So have you seen a QOQ improvement in that number?
Sanjeev? Yeah, so we are seeing good traction. So there is a growth quarter by quarter, and obviously a bit more momentum because of Omicron and all those things. But yes, Q3 versus Q2 numbers are increasing, and Q3 was also a period wherein we focused more on ensuring that the operational part or the capacities that we have across the Flego network through AHLL as well as the pharmacy shops as well as the doctors, Apollo doctors on the platform. There was a high focus, management focus on ensuring that all that operational part gets stitched up well before we enter into Q4, because we all knew it and we all had some information, right, that Omicron is also partly coming to the country. So I think Q3 focus more was on the operation side of it, but yes, on the financial metrics, we were still better off versus Q2.
So Sanjay, is it 10,000? No, if you can share the numbers, please, because we shared that in the last call. This is why I'm asking the continuing.
Yeah, so I think as far as the pharmacy side of it is concerned, I think if you look at the Omni channel play, we continue to do in the range of about 45,000 deliveries a day. And as far as the other two segments are concerned, it should be in the range of about 5,000 a day.
Okay, got it. Very helpful. Second question is on the startup losses in 24/7. They have gone up. I missed the comments that why it had gone from 40 crore per quarter to now 55. What is driving it?
No, it's not 40 crores to 55. It's from 48 crores to 55 crores. We have some added employee strength, and the system is, increasing on the manpower. So there is no significant other changes, and slight increase in the marketing spend. It is from 48 to 55 crores in the quarter.
Yeah, got it. So can you share what is the discounting level that you are now giving for on a blended basis? I remember it was 12 or 13%.
We are in the range of 12 to 13% as of now.
Okay, very helpful. Second question is on the economics for the...
Just sorry to add that is for a particular value of the bill, and above 200 we don't give any discount. So we manage below 200 value of the bill, no discount. So we have some averages coming in different. But as a range, we are in 130.
Very helpful. Second question is on the economics for SAP. When we did the announcement, we were talking about an 80% back end to front end profit share. I can see that number in revenue for sure, there is no doubt. But in EBITDA, you now give for the platform business EBITDA post Ind AS. You also give us what you assume in your numbers, and that number is 63%. So why is there the discrepancy between revenue recognition versus EBITDA?
So you're probably looking at the post-Ind AS numbers. If you look at the pre-Ind AS numbers, it is aligned to that, because that is you're looking at it after the lease rent. Look at the pre-Ind AS numbers, which includes the lease rent also, which is the cost for the front end. So if you consider it basis that, you would realize that it is the entire economics is captured in AS.
We are in the range of 78 to 82% in the last 3 quarters.
Okay, so since you don't share that other number, which is where I'm trying to compare with the number on the platform pharmacy which you give us. So, but you sure. Okay, perfect. And thank you so much for my. Thank you.
Thank you. The next question is from the line of Krishnendu Saha from Quantum AMC. Please go ahead.
Yeah, can you hear me?
Yes, we can.
Yeah. It's just a simple question. For the 24/7, what would be the GMV number be for the quarter?
Sorry, can you repeat that question?
What would be the GMV number for the quarter be?
Sanjeev, GMV for 24/7 for the platform as a whole.
I think at this stage, we would like to, start putting up the numbers from the next quarter, and I would request, just to bear with us for some more time. But from next quarter onwards, we should be able to provide you the GMV and the related numbers also.
Yeah, understood. Another clarification, a gentleman asked before, if the stakes, does the expansion in Delhi Gurgaon and Noida depend on the stake sale, or is it that we are going ahead even in the fact that we don't get the full amount, or we get part of the amount, or part of the stake sale goes through for 24/7?
So I think we have a very strong balance sheet that will support this expansion.
I see. Could you just?
So that is definitely happening.
So the 24/7 will also happen.
So it is not subject to the 24/7 deal.
It is not, but we are saying it will also happen. That's all.
Oh, sure. And just could you just run me through the capex plan then for the hospital business for the next 2 years, when we're going to add around 2,000 beds for the next 2-3 years? Could you just give me that, please?
Can we get back to you on that? So if you look at it, as Sunita said, we have a plan for Bangalore that would be almost around, in the range of 700-800 crores overall, between the expansion and the new hospital which will be there in Hennur. So we have to look at, we're still closing some of this in North Bangalore. So I guess once we have those, and the other thing in the South Bombay also, it will be a project which is a 400 crore project, which will include between 600 to 750 crores of capex. That is the second which will be there. The other one which we are looking at between the two sides of Delhi, clearly those are again potentially another 1,500 crores at least between the two hospitals. So we will come back to you with more details as we are.
Time frame. So at this time, we have about 700 crores in mutual funds. So combined with free cash flows and the fact that the 24/7 money will come, I think we will be adequately enabled to fund this growth.
Sure. And the last clarification, did I hear correctly, is because of the COVID footfalls or vaccination footfalls being low, the outpatient was low?
That's correct.
Yeah. Thank you for your time. Thank you. Have a good weekend. Thanks.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
And thank you for the repeat. My question has been asked. Just a couple of things. When I think about 24/7, Apollo has been traditionally very strong in offline, capabilities, and online is something that's pretty new, both from the tech side and last mile delivery side. So, when you think about building this platform out, next 1 year, 1.5 years, which are the main capability gaps, and what are the areas that you want to focus on?
So I think first of all, from the infrastructure point of view, I think we are well sorted out, given the fact that we've got 4,400 stores to light up onto the platform, plus we've got a large network of doctors, as well as we've got the Flebo and the lab network, plus various other things that we are doing on the condition management. On the clinical side, we've got the again a good knowledge in all those fronts. I think if I'm honest to this question, I think from the technology side, the challenge that I see is that this is a ever evolving kind of a thing. Customer or the patient requirements keep changing and the dynamics keep changing. So I think from the technology side, we continue to see that there is a lot more to do all the time. In spite of what we thought initially, that this is how the entire tech platform has to look like, but I think and that is continuing evolving. So I guess the challenge is with respect to where do you kind of put the boundaries with respect to the expectations comes from the customers or the patients versus what we as a company would like to deliver. So I think that is what I would see is one of the challenge could be in the next 6 to 12 months that we need to kind of overpass.
Okay, and that's very helpful. And is there a milestone or is there a proof of a pudding sort of a thing that when you get to that you say, okay, fine, now our tech build out is satisfactory?
Yeah, so I think everything is, outside in approach, once we start. So it's all customer driven, once we voice of the customer suggest or, we've got our own internal milestones that these are the things, these are the developments that are required for the condition management, for the CDHS and so many things. And so I think one is that we'll get more assurance, once we reach to those milestones. And second, I think voice of the customer continuously help us understand that what more is needed to be done. So I think 1 year from here, we should be in a much better position to say that from the technology side, we've developed what we wanted to develop.
Thanks, Sanjeev. Are you doing this in-house or you're getting this done outsourced?
Yeah, so we have a set of engineers, based out of Gurgaon as well as based out of Bangalore. And pretty much this entire developers team and engineers, they're all in-house. And this is all done internally, sir.
Okay, great. Thanks. Just final, you mentioned about J&K MOU for 250 beds. Can you talk a bit more about this?
It's still an MOU for now because it's an MOU where we are working with the government. The government has to identify the land and give it to us. We are working with them. We have committed for the hospital there because it was something that the government wanted to do, and we are happy to put something there.
Okay, great. Thank you so much.
That it's a huge unserved population. So I think even the business case for it is a very strong business case.
Yeah, we did that. That's correct. A lot of people from Jammu come to Delhi today for care.
Okay, great. Thank you so much.
Thank you. That was the last question. I now hand the conference over to management for closing comments.
So thank you, ladies and gentlemen, for taking time off on a Saturday afternoon. As you have seen, Apollo has demonstrated not only resilience, which was remarkable during COVID and the pandemic, but more importantly, we have been very agile in creating an institution that moves closer to the customer without losing focus on our clinical DNA. I believe that each one of the verticals, Apollo Hospital, Apollo Health and Lifestyle, and Apollo Healthco, have demonstrated not only agility, but value creation for all of Apollo and for all of its stakeholders. So thank you, ladies and gentlemen.
Thank you very much. On behalf of Apollo Hospital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.